The smartest money on Wall Street is quietly positioning for something most investors can't see coming. While everyone celebrates record highs and artificial intelligence breakthroughs, a select group of financial veterans are preparing for what they believe will be the most significant market disruption since the Great Financial Crisis. They're not panicking, they're not selling everything. Instead, they're doing something far more calculated. They're hunting for the hidden opportunity that emerges when markets collapse. History teaches us that the greatest fortunes are made not during boom times, but during the chaos that follows. When everyone else is running for the exits, when fear grips the financial world, when headlines scream about economic disaster, that's precisely when patient investors with the right strategy can acquire assets at prices that seem impossible today. The year 2026 is shaping up to be one of those rare moments when everything changes. But here's what makes this different from every other market prediction you've heard. This isn't about timing the market or hoping for luck. This is about understanding patterns that have repeated for over a century, recognizing warning signs that are flashing red across multiple indicators, and positioning yourself to benefit from what appears inevitable rather than hoping it doesn't happen. The foundation of this opportunity rests on a simple but powerful truth. Markets don't crash randomly. They follow predictable cycles driven by human psychology, debt accumulation, and asset mispricing. And right now, multiple signals are converging in ways we haven't seen since before previous major corrections. The question isn't whether a significant market event will occur. The question is whether you'll be positioned to capitalize on it. Let's start with the elephant in the room that nobody wants to discuss. The artificial intelligence bubble has reached proportions that dwarf even the dot-com mania of the late 1990s. Companies are collectively spending over $400 billion this year alone on AI infrastructure, with projections reaching $500 billion by 2026. To put that in perspective, that's more money than any group of companies has ever spent on anything in such a concentrated time frame. But here's the disturbing reality behind these massive expenditures. While companies pour trillions into AI data centers and computing power, actual production deployment at meaningful scale remains stuck at just 5%. The gap between investment and real-world application isn't just wide, it's a chasm that grows larger every quarter. The failure rates tell an even more sobering story. Research from MIT reveals that 95% of AI pilot programs crash and burn before reaching implementation. McKinsey reports that only 10% of companies have successfully deployed generative AI at any meaningful scale. Gartner found that 40% of AI projects get cancelled before they even launch. These aren't small companies making rookie mistakes. These are Fortune 500 corporations with unlimited resources and top-tier talent. What we're witnessing is a classic speculative bubble, built on promises rather than performance. Private money is hiding failure rates that public markets would never tolerate. When reality finally catches up with expectations, the correction will be swift and merciless. Companies that have spent fortunes on AI infrastructure with little to show for it will see their valuations collapse. Investors who believe the hype will watch their portfolios evaporate. But this AI bubble is just one piece of a much larger puzzle. Market valuation indicators are screaming warnings that seasoned investors recognize as danger signals. The Shiller CAPE ratio, which measures stock prices relative to long-term earnings, has reached its second highest level in history. The only time it was higher was right before the dot-com crash. The Buffett indicator, which compares total market capitalization to GDP, has hit an all-time high of 219%. Warren Buffett himself has warned that investors at these levels are playing with fire. When the world's most successful investor sounds the alarm, smart money pays attention. Even more concerning is the concentration of market gains in just a handful of technology companies. The so-called Magnificent Seven stocks now control 37% of the entire S&P 500. This concentration makes the current bubble 17 times larger than the dot-com crisis in terms of market impact. When these 7 companies fall, and they will fall, they won't just decline, they'll drag the entire market down with them. Historical patterns add another layer of evidence to the case for a 2026 correction. A fascinating investment timing chart created in 1875 by Samuel Benner, based on commodity and market cycles, predicted market crashes with remarkable accuracy. His model, which follows 18 to 20-year rhythms of market upheaval, points directly to 2026 as the next major correction. The economic fundamentals supporting this prediction are becoming impossible to ignore. Inflation, which many believed was conquered, is showing signs of resurgence. Experts now believe the 2026 inflation rate will exceed current levels, eroding consumer purchasing power and weighing heavily on spending. Tariff policies are expected to remain elevated, adding additional inflationary pressure that will become evident in higher consumer prices. The housing market, which has been a pillar of economic stability, is showing cracks that threaten the entire foundation. Four converging factors are creating perfect storm conditions: economic slowdown, consumer financial strain, unaffordable home prices, and persistently high interest rates are all working together to destabilize what has been the backbone of middle-class wealth building. Momentum in real estate has already shifted from bidding wars to falling prices. Unless wages surge dramatically or long-term interest rates drop significantly, home prices are likely to revert to pre-pandemic levels. The affordability crisis has reached record lows, creating negative feedback loops that will accelerate economic downturn by 2026. Corporate debt levels present perhaps the most systemic risk of all. Many large companies, even those with high market capitalizations, are carrying substantial short-term debt loads. Most have current ratios below 1, meaning they have more short-term obligations than liquid assets to meet them. Despite appearing profitable on the surface, these companies are walking a financial tightrope. A small disruption could force them to borrow more, lay off staff, or default on debts. Mass layoffs and corporate defaults are classic recession catalysts. The government debt situation adds another explosive element to this volatile mixture. Annual trillion-dollar deficits have pushed national debt to levels that threaten the traditional safe haven status of US bonds. If confidence in government bonds wavers during a financial crisis, the usual bailout mechanisms may not be available. The deep fiscal and monetary structures that have generated boom and bust cycles for 2 centuries remain unchanged, setting the stage for the next inevitable correction. But here's where the hidden opportunity emerges from this seemingly dire situation. Every major market correction in history has created wealth for those positioned to take advantage of the chaos. Fear and volatility don't just destroy value. They transfer it from the unprepared to the prepared, from the emotional to the rational, from those who panic to those who plan. The key lies in understanding that market meltdowns are not just destructive forces. They're wealth redistribution events. When assets become dramatically undervalued, when quality companies trade at fractions of their intrinsic worth, when entire sectors are abandoned by fearful investors, that's precisely when patient capital can achieve extraordinary returns. The opportunity isn't just theoretical, it's backed by historical evidence spanning over a century of market cycles. Every major correction has eventually reversed, swinging higher and rewarding those who had the courage and capital to buy when others were selling. The pattern is as reliable as gravity. The recovery periods following market crashes consistently produce the highest returns for investors who position themselves correctly during the downturn. Stock markets that fall dramatically during recessions typically rebound with even greater force during recovery phases. Properties purchased at depressed prices during economic stress appreciate substantially as conditions normalize. The mathematical reality is simple but profound. When quality assets become available at 50 or 60% discounts, the upside potential becomes enormous. But capturing this opportunity requires more than just waiting for prices to fall. It demands a specific strategy built around identifying the right companies, the right sectors, and the right timing. The winners during market meltdowns share common characteristics that separate them from the casualties. They maintain strong balance sheets with minimal debt. They generate consistent cash flow regardless of economic conditions. They operate in essential industries that people need even during tough times. Quality companies with deep competitive moats don't just survive recessions, they emerge stronger by taking market share from weaker competitors who can't weather the storm. These businesses often use downturns to acquire assets, talent, and customers at bargain prices. When the economy recovers, they're positioned to dominate their industries with expanded capabilities and reduced competition. The healthcare sector exemplifies this dynamic perfectly. People need medical care regardless of economic conditions. Pharmaceutical companies with proven drugs continue generating revenue even when consumers cut discretionary spending. Medical device manufacturers serving aging populations maintain steady demand. Healthcare real estate investment trusts collect rent from hospitals and clinics that can't simply disappear during recessions. Consumer staples represent another defensive opportunity that thrives during market chaos. Companies producing food, beverages, household products, and personal care items maintain pricing power even when luxury spending collapses. Grocery stores, discount retailers, and value-focused brands often see increased demand as consumers trade down from premium alternatives. Utilities provide essential services that generate predictable cash flows regardless of economic turbulence. Electric companies, water utilities, and natural gas providers collect payments from customers who have no choice but to pay their bills. These businesses often carry substantial debt, but it's backed by regulated rate structures that virtually guarantee repayment. During market meltdowns, utilities become safe harbors that also pay attractive dividends. The dividend strategy deserves special attention because it transforms the waiting period into a profitable experience. Instead of simply hoping for price appreciation, dividend-paying stocks provide regular income that compounds over time. Companies that maintain or increase dividends during recessions demonstrate financial strength and management discipline that markets eventually reward with higher valuations. Real estate investment trusts offer particularly compelling dividend opportunities during market downturns. Essential property types like apartments, healthcare facilities, data centers, and warehouses continue generating rental income even when office buildings and retail centers struggle. Many REITs trade at significant discounts to their underlying property values during market stress, creating both income and appreciation potential. The international diversification angle opens additional opportunities that most investors overlook during domestic market chaos. While US markets may be overvalued and vulnerable, other regions often trade at more reasonable multiples. Emerging markets, European value stocks, and developed Asian economies can provide both diversification benefits and superior return potential when American assets are expensive. Currency considerations add another layer of opportunity for sophisticated investors. During dollar strength periods, international assets become cheaper for American investors. When the dollar eventually weakens, those foreign investments provide additional returns through currency appreciation. This dual benefit can dramatically enhance total returns for patient investors willing to look beyond domestic markets. The precious metals component of crisis investing goes far beyond simple gold ownership. Silver, platinum, and palladium each respond differently to various economic scenarios. Mining companies often trade at extreme discounts during market stress, providing leveraged exposure to metal price recovery. Royalty companies offer exposure to mining profits without operational risks. Even metal streaming companies provide steady cash flows backed by physical commodity production. But perhaps the most powerful opportunity lies in the debt markets during crisis periods. High-quality corporate bonds often trade at yields that seem impossible during normal times. Investment-grade companies with temporary liquidity concerns may issue bonds at distressed prices that provide extraordinary returns for investors with available capital. Convertible bonds offer the safety of fixed income with the upside potential of equity participation. The psychology of crisis investing cannot be underestimated because it determines who captures these opportunities and who becomes a casualty. When markets crash, fear overwhelms logic. Headlines scream about economic disaster. Financial media promotes panic selling. Friends and family question any investment activity. The pressure to join the crowd and abandon rational strategy becomes overwhelming. Successful crisis investors develop specific mental frameworks that allow them to act when others freeze. They understand that maximum pessimism creates maximum opportunity. They recognize that temporary problems create permanent wealth for those who can see beyond current conditions. They accept that being early feels wrong until it feels brilliant. The preparation phase requires building specific capabilities before the crisis arrives. Cash reserves provide the ammunition needed to act when opportunities appear. Watch lists of quality companies help focus attention on the most promising targets. Predetermined purchase criteria remove emotional decision-making from the investment process. Tax loss harvesting strategies can offset gains with strategic losses.